Hello everybody, welcome to another update on the stock screener. I got a request to review ORA Minerals. I know nothing about this company, so let's do it. So let's check it. Something happened in 2020. It went up fourfold, so it looks interesting, but it hasn't gone up a lot since then. Okay, so 894 CAD is 712. So it's a large cap. Target double and a lot of dividend. Let's look at the investor information, financial statements. So that's September. We have revenue of 100 million per quarter. So that's Q3. $100 million. Let's just do net income. That's not good. Negative. But the gross margins are positive. Okay, they had impairment, apparently. If we don't take into account impairment, it would still have 25 million. So it's a profitable company. Problem is, yeah, I can't just put these numbers here and look at it because they had an impairment. Let's just do it. And the equity is $276 million. Get 276 million equity. So price to book is 2.6. That's overvalued, but let's see. Okay, so these net earnings are not to be relied upon. So let's take the last Q2 quarter. And see what we have here. 111.7. Net earnings 21.5. Which was what I calculated earlier. And equity 288.9. So something bad happened between Q2 and Q3. Let's take net earnings of 21. So we have a PE of 33. No, you need to take 4 folds. So PE of 8. That's a good company. Fair value. So it's looking good. Let's insert a chart. That's not the chart that I want. That's better. Okay, Q2, Q3, net earnings, revenue, and equity. So looks like a very normal company. And what's the debt? The debt is 308. 308 million. 308 million. That's higher than equity. So that's not good. And yeah, it's real debt. 100. So not sure why there's so much debt. What's 11? Whoa, a lot of debt at high interest rates. And most of it is, what, 15%? That's a lot of debt. 15% debt interest rates. And 7%. These are very high interest rates. So that's one issue that we found with this company. High debt, low equity, and high interest rates. But they have earnings. So they could pay off that debt easily with 80 million in earnings. Probably paid off in 4 years. So it's not too bad. Now, what was this impairment charge about? Do they say anything about that? I don't see anything about impairment charges. So not sure why they are not saying anything about that, but let's see. 9. Impairment. So they just said there's an impairment, but said nothing about it. Impairment on mineral properties. Okay. Doesn't matter. The price to book is still 2.5, which is very high. Okay, let's look at the presentation. Multi-mine copper. 4 mines. Okay. 30% higher at one plant. 8% dividend, which is also what they say here. So that's interesting. Production is rising. And apparently it's rising a lot. I like to see production growth. So production is currently at let's say 270. And production in 2024 is 400, let's say 450. So that's a double in 3 years. So that's good. And it has copper and gold. Very good metals. Now let's go over to the cost. They take copper equivalent here, but why do they take copper equivalent? Those are good margins, 41%. 204, okay. But I still don't see any cost guidance. So Almas, Ernesto, Almas, and others. outstanding shares. Not a lot of dilution, that's good. 72 million shares. I like the dividend yield, 8%. So they think they can be profitable. Grades are not that impressive. Probably open pit. And they have 2 million ounces of gold and copper, 30%. So let's say they have probably 3 million ounces of gold. In proven and probable. And for measured is 1.6. Let's say 2 million, which is a total of 5. 5 million for producing mine times 50 is 2. So it's not that they have a lot of resources. If they produce 300,000, maybe 10-year mine life. So they will need to explore for more resources. So a lot of money will be put into the ground again. Apparently there is Almas with an NPV of 260. And that is also calculated probably in the growth. Yeah, Almas. So that's in our calculation. This is just exploration, and this is exploration. Okay. Almas, okay. I still don't see any costs, which is a very worrisome. And that's it. No AISC. I don't like that. Where is my cost? And where is the news? So we have a third quarter financial statements, and I don't see anything on that here. Where is my news? This is a really bad company on news releases. Very bad. Bad communication, bad website. I can't work like this. So production 270. That's correct. So they provide cash costs at 800, but that's not the all-in sustaining cost. So let's just estimate it then. I would estimate it at 1000. From 800 to 1000. If they don't provide anything, I can't help them. Okay, so let's just put 1000 here. Cash costs we have, but we don't have AIC. And this way we can create our valuation. Production times gold minus 1000 times 5. So it's worth 1 billion. Let's assume that this is about the same cost. Then it could go to 2 billion. So it's about a double, a little bit more in a few years. So that's not bad. Seems like a good company. Can we look at Alma? Or how it's called? What was it called? Almas. Not sure where I can find it. ORA minerals, okay. Do we have a technical report? We have a technical report. So let's take a look at Almas. This is the Almas project. Sensitivity analysis. Let's chart this out. Almas. So what was the gold price? This is 5%. $1,588. An investment of 73 would be required. Thirteen-year mine life. Good return. And 183. At 1,588. And gold protection of 35560. AISC 828. That's good. We have all the data. So this is worth 183 million, which is exact this number here. Okay, sensitivity analysis. Plus 10% would give us 232. And we have a trend line. So at current prices, it's about 260 NPV. I think worth 150. So this project is worth 150, not a lot. Production is only going to increase it by 35,000. So I don't know where this is coming from. It certainly doesn't come from Almas. Okay, what was the other technical report? So this here, I don't know where this is coming from. Matupa development, conversion of new deposits, Aranzazu increase, Gold Road increase, which is completely wrong because Gold Road's decision to stop investing in Gold Road mine. So that's not going to happen. So this here is completely wrong. So I don't believe these numbers at all. It certainly doesn't come from Almas. So somehow this block here is just fairy tales. So let's say 400 is a better estimate. And that gives us 1.7. Let's say 1.5. Still a double. Not bad. This is a feasibility study of Aranzazu. AISC 280. Oh, that's very low cost because of the byproducts. 1.8 for copper. Doesn't matter because we have cash cost of 800, which is pretty low, but not super low. So let's chart this out. We put gold price, market cap, fair value. We have 160, market cap 72, and this is production times gold price minus AIC times 5. $1 billion, and in 2024, We take this AIC, this production. And we get 1560. I don't know. Why is it 1560? Okay, this is B20 times 1860. Okay, yeah, this is gold price. This is completely wrong. Okay, that's better. Okay, so we have a market cap of 700 and it has upside to 1 billion and then it can go to 1.7 billion. Problem is it's already at price to book of 2.5, so equity is much lower at 276, somewhere here. So this equity has a long way to go from here to here. So that's why I don't like this company that much. PE is also 8, not special. So yeah, it has potential. But the main thing I don't like is the equity, which is very low. And the equity consists of mostly cash and a lot of property, plant, and equipment. I like the amount of cash, okay, but it also has a lot of debt. So that's the second thing. I don't like the debt. I don't like the low equity. PE is not that special. We have companies that have a PE of 5, like Gran Colombia, and this has a PE of 8.5. Alma's project is not that leveraged to gold and also has not a lot of production, 25,000 compared to 270 right now. This 400, I don't know if they can achieve that because they have This is fairy tale land. Construction, yeah, Mine Life 13 is good. Fair value is higher, of course, but problem is the book value. Financials, net earnings were negative here, but here it's positive 20. So we'll see how that goes. Rising production, okay. But this target, I'm not sure they can achieve that. So yeah, and also the debt has a lot of interest rates on it. Cash was good. What's 165? And cash cost is very good, 1000. So basically, if you hold this a long time, this will do well. But you will need to wait quite a long time because the equity is still low. So I think this rise here, they got ahead of themselves. The equity is much lower. Equity is somewhere here at $6. So I think this could bounce between fair value and book value. So it would probably stay at this level for maybe 1 to 2 years until the equity rises, and then the share price can start rising when production rises. So I don't see a lot of upside in the short term, but in the long term, it can rise as the equity goes up. If they don't start doing more of those impairment charges that they don't talk about. So yeah, looks like a good company, but I wouldn't buy it. That's my conclusion. And I'll see you in the next video.